What if you could grow your money while also making the world a better place? Sounds like a dream, right? But here's the twist. It's real, and it's called impact investing. And what you're about to discover today just might change how you think about money forever. But stick with me, because there's one surprising thing about impact investing that almost nobody tells beginners, and you'll want to know it before you jump in. Number one, what exactly is impact investing? Let's start at the very beginning. What does impact investing even mean? In simple terms, impact investing is putting your money into investments that not only aim to make you a financial return, but also create a positive social or environmental impact. It's like saying, I want to earn money and help solve problems in the world at the same time. For example, imagine you invest in a company that builds affordable housing in low-income neighborhoods. Your investment could grow in value while also providing homes for families who need them most. It's different from just donating to charity because you're expecting your money to come back with profit. You can think of it as a win-win. Good for you. Good for the world. Number two, why does impact investing even matter? Now you might be wondering, why bother with this when I could just invest for maximum profit and then donate later? Well, here's the thing. Our world faces big challenges like climate change, poverty, and inequality. According to a recent survey by Morgan Stanley, 85% of investors and over 95% of millennials say they care about making investments that align with their values. Impact investing is a way to align your money with your heart instead of making a fortune in something harmful like tobacco or oil and then giving it away later. You start by choosing investments that help instead of hurt. One example, investing in clean energy companies that reduce carbon emissions, or in microfinance funds that lend small amounts to entrepreneurs in poor countries to help them start businesses. That way, you're already helping as you grow your wealth. Number three, how does impact investing actually work? So how do you do impact investing? Well, impact investments can come in many forms: stocks, bonds, mutual funds, exchange-traded funds, ETFs, private equity, and more. For beginners, the easiest way is usually through mutual funds or ETFs that focus on social and environmental goals. For example, you can buy shares in an ESG fund that stands for environmental, social, and governance, which avoids companies that pollute or exploit workers and favors ones that improve the planet and communities. You don't need millions of dollars to start. Some platforms let you begin with as little as $50. One beginner-friendly example is the Calvert Impact Fund. It invests in things like affordable housing and renewable energy, and anyone can buy shares through a brokerage account. Number four, does it make you less money? Here's the big question everyone asks. If you're focused on doing good, does that mean you make less? It's a fair question, but research shows that's not necessarily true. Many studies have found that impact investments can perform just as well as, or even better than, traditional investments over time. Why? Because companies that care about people and the planet tend to avoid lawsuits, attract better employees, and build stronger reputations, all of which help their bottom line. For example, Tesla made a fortune for investors while accelerating the world toward electric cars. So no, you don't have to sacrifice returns just to feel good about where your money is going. Number five, what kinds of things can you invest in? The cool thing about impact investing is how many options there are. You can invest in renewable energy like wind and solar. You can invest in affordable housing. You can invest in companies that make clean water technology. You can invest in education funds that build schools in underserved areas. One inspiring example is microfinance, small loans to women in developing countries to help them start businesses. Studies show that these women often repay their loans and lift their families out of poverty. So whatever cause you care about, there's probably an investment for it. Number six, how can you tell if it's really making an impact? Now here's the catch I promised earlier. Not every fund or company that says it's impact really is. Some big investment firms slap labels like green or socially responsible on products without much proof. This is called greenwashing, and it's why you need to do your homework. Look for funds and companies that report measurable results, like how many tons of carbon they cut, how many families got affordable homes, or how many kids got access to education. Many funds publish annual impact reports you can read before you invest. For example, One renewable energy fund I reviewed last year showed they helped reduce carbon emissions by over 500,000 tons, the same as taking 1,000,000 cars off the road. That's the kind of clear evidence you want to see. Number 7. How do you get started as a beginner? Okay, you're excited, but how do you actually start? Here's a simple step-by-step. Step 1. Decide what causes you care about. Is it climate change? Poverty? Gender equality? Step 2. Research mutual funds or ETFs that focus on those causes. You can search for ESG or SRI, socially responsible investing, funds online. Step 3. Open a brokerage account. If you already have one, great. You can usually buy these funds just like you'd buy any other stock or ETF. Step 4. Start small. You don't have to pour all your savings into impact investing right away. Even $100 is a fine start. Step 5. Monitor both your financial returns and the impact reports to see how your money is making a difference. It really can be that simple. Number 8. A real-life example to inspire you. Let me tell you about Maya, a young teacher from Chicago. She wanted to invest, but hated the idea of her money supporting things she didn't believe in. So she put $200 a month into an ESG fund that focused on clean energy and affordable housing. 10 years later, her account had grown nicely. But more importantly, she was proud to tell her students how her investments helped reduce pollution and build homes for families like theirs. She said, "It's not just about the money anymore. It's about making my money mean something." That's the power of impact investing. Number 9. What's the downside? Nothing is perfect, so here's what to watch out for. Some impact. Investments can have higher fees than traditional funds. Some might not be as diversified, meaning you could take on more risk if they focus too narrowly. And, as I mentioned earlier, greenwashing is a real concern, so always read the details carefully. But if you're thoughtful and choose wisely, these risks are manageable and worth it for many investors. Number 10. How impact investing compares to traditional investing. Let's say you're comparing two roads. One is the usual road most investors take. You put your money where you think you'll get the biggest financial return, and that's the only goal. The other is impact investing, where you still aim for solid financial returns, but you also care about what happens along the way. Imagine investing in a company that makes sugary drinks versus one that makes healthy school lunches. Both could make money, but which feels better to you? That's really what sets impact investing apart. It lets your personal values guide where your money goes. And here's a secret. Studies show that younger generations, like millennials and Gen Z, are driving this trend because they want their money to reflect their beliefs. So you're not alone if you care about more than just the bottom line. Number 11. The numbers behind impact investing. You might be wondering, how big is this? The Global Impact Investing Network reported in its latest survey that impact investing worldwide has grown to over $1 trillion in assets. That's right. Over $1 trillion is already at work trying to solve social and environmental problems, and the number keeps growing as more people wake up to the idea. Even giant pension funds, big banks, and insurance companies are adding impact investments to their portfolios. So this is not just a fringe idea. It's becoming mainstream. Number 12. What if you change your mind? Now some beginners worry, what if I start investing in impact funds and then later want to switch? Good news. Most impact investments, especially the mutual funds and ETFs, can be sold just like any other investment. You're not locked in forever. For example, if you invested in an ESG fund and later decided to move your money elsewhere, you could usually sell it through your brokerage account and buy something else. That flexibility makes it easier for beginners to try impact investing without fear of being stuck. Number 13. What about taxes? Here's something many beginners forget to ask. How does impact investing affect taxes? The answer is, impact investing is not tax-free just because it does good. Any profits you earn, like dividends, interest, or capital gains, are still taxable, just like with any other investment. But there are ways to be tax efficient, like holding your impact investments in a retirement account, such as an IRA or 401k, where your gains can grow tax-deferred. And some municipal impact bonds may even offer tax advantages, so don't assume you're off the hook for taxes. Always check. Number 14. Can small investors really make an impact? Here's a question I hear all the time. I'm just one person. Does my little investment really matter? And the answer is a big yes. When thousands of individual investors put even modest amounts into impact funds, it adds up fast. Think about crowdfunding. One person giving $50 doesn't seem like much, but thousands doing it can fund a whole project. Impact investing works the same way. You may feel like a drop in the ocean, but remember, the ocean is made of drops. Number 15. How to spot red flags. Here's one last tip to protect yourself as you get started. Watch out for red flags. If a company or fund claims its impact but gives no proof, be suspicious. If fees seem unusually high without clear explanation, that's a warning sign too. Look for funds with transparency. Ones that publish impact reports, have a clear mission, and explain how they measure success. For example, a real impact fund might report, "We financed 3,000 affordable housing units this year," while a questionable one might just say, "We care about communities," without any data. Trust your gut. If it feels vague or too good to be true, dig deeper. And here's the question I'll leave you with. If you could choose one thing your money could help change in the world, what would it be? Drop your answer in the comments. I can't wait to see what matters most to you.